HP just reported pretty okay results, but the market really likes it and it's up after hours. And so let's dive into the results and see exactly what happened. So as you guys smash that like button, let me run that intro. What's up guys and welcome back to the channel. And so you can see that HP reported results last night, and as you can imagine, in pre-market the market actually enjoyed the results and they're up almost 2%. As of the recording of this video, it's 4 a.m. right now, so we got a couple more hours before the market opens, so we'll see where this lands. And so for those of you who are not familiar with HP, they're effectively just, they sell computer hardware, so at the consumer level and at the commercial level. You would think, just based on our experience with HP, that they would be selling more at the consumer level, because that's pretty much all you see when you go into Best Buy and such. But it's very interesting how the commercial side actually has more, and I guess that kind of makes sense. But it was a surprise to me when I was first looking at the company. And so the second part of the company is the printing supplies. So these two are I look at them as one segment, and then this is another segment in itself. And then of course the difference between commercial and consumer are just subsegments. And so they tell you right here that 2/3 of their revenue comes from personal systems and 1/3 of their revenue comes from printing. And in fact, you can just put all this together, and the largest subsegment is the supplies. So that's largely the company. It's computers and printing. And so when it comes to the personal systems segment, notice that revenue was down 24% year over year. However, I think the reason why the market is reacting positively to the results is because we're starting to see a reversal of this downward trend that we saw throughout 2022, and it looks like Q1 did reverse a little bit. So we'll see how the trend plays out. In 2021, Q1 was a little bit high. Q2 was a little bit higher. In 2022, Q2 was a little bit lower. So we'll see. Ultimately, the guidance that they're providing suggests that things are going in accordance with expectations, and so we'll see how this plays out, but largely this is a positive news story. Now with printing, it looks like it's also begun to stabilize a bit. Printing overall is just a more stable business segment, and so revenue is down 5% year over year. However, it looks like it's starting to stabilize and go backwards, back up as well, and so that's a good news story. And so with their outlook, I think the outlook has largely remained unchanged. But notice, guys, that because the shares are trading at 29.5 as of the previous close, the company is largely trading at 11.3 to 13.3 times earnings. And that's on expected GAAP diluted net EPS. On a non-GAAP basis, which adjusts out all their restructuring charges, of course, the company is trading much cheaper on a valuation perspective. And if you just look at the free cash flow, their current market cap is around $29 billion. And so, they're trading on somewhere around an 8 to 9 times free cash flow. And so, the valuation here looks pretty interesting. And so, this is why, full disclosure, this actually is not just a position that I hold for my own portfolio. In fact, I have been increasing the position in 2023, but it's also a position that I put in the baby's educational portfolio as well. I just think this is a stable company that will be relatively okay throughout the long term. Now, none of that is a recommendation for you to buy the security. This is just my opinion and my analysis. Always seek an investment advisor before you make any decisions for your portfolio. Now, one thing that a lot of people may have missed is that the company is actually going through a cost restructuring where they're looking to generate approximately $1.4 billion in run rate cost savings. And so part of that is that they're going to do a headcount reduction as well. And so, what does this mean to future earnings per share? Well, I'll give you a long-term and a short-term view. So over the long term, they expect, revenues to continue to grow at the low single digits, but they expect EPS to grow at the high single digits. And, that doesn't necessarily mean that they're going to be perpetually generating cost savings to make themselves more profitable. No, what they're really doing and what's going to be really growing out this non-GAAP EPS, or at least what's expected to grow it out, is the fact that they're going to be buying back shares. I think that's the reason why they're forecasting high single-digit EPS growth, because every year there's just going to be fewer shares. Now, just because there is a focus on taxing share buybacks into the future, and I think they probably probably will eventually push forward higher taxes, not just that 1%. It's a good idea to, reconsider your capital allocation strategy and consider a strategy where you pay down the debt a little bit more. If HP does have some debt on its balance sheet, and that's a real good way to create shareholder value by getting rid of some of that debt, because it eliminates that debt penalization from the valuation. And so I think that's another thing that they should consider. They are targeting leverage, which is fine, but there might be some scenarios where it might just be better to pay down debt as opposed to buy back shares. I'm not opposed to either way to allocate that capital. In fact, I would rather that they have zero debt on the balance sheet. You can't go bankrupt if you have no debt. And now here's what those cost savings mean to the earnings per share. So you can see that, I forecast on a GAAP basis. And so, they're expecting to earn around $2.50 per share in 2023. And then, it should be expected to slowly increase to around $4 per share by 2025. And so ultimately, I think this is, over the long term, is an approximately $4 per share stock, which is trading at around 7.5 times earnings. So, it's a pretty solid yielding type opportunity. That 4 divided by 29.5 reflects an equity yield of approximately 13.5%. So it's not bad. And once again, it's something that I've put in my portfolio. And once again, it's not a recommendation, but ultimately really what it is this is a stable, consistent, long-term investment that I'm probably just not going to have to worry about. Now, when I bought them closer to around $27 per share, not necessarily, the current share price of $30 per share. So I think I got a little bit lucky there, but I want you guys to let me know what you guys think about this company. Is this something that you would allocate your capital to? Now, the other thing is I recently put out a Q&A video where I walked through how to value Alphabet. And so if you missed that video, you can get to it right here.